So I recently learned about a strategy where you can basically supercharge you paying off the mortgage on your principal residence. And I'm pretty pissed that I've only just recently learned about this. Freaking blew my mind because I've owned rental properties in the past. And had I been doing this from the start, I wouldn't even have a mortgage right now, or I'd probably be pretty close to not having a mortgage. But anyways, this strategy works amazing for, well, really anybody who wants to do it, but especially for people who already have equity in a home that are just looking for a way to pay it off faster and be debt free, possibly even in the next decade, right? So this strategy is called cash damming. And essentially the way it works is you're going to go to a bank who provides you, it's called an advanceable line of credit. And the way it works is, let's say you have a $10,000 home equity line of credit. When you pay down $5,000 of principal on your home, that line gets increased to $15,000. So as you pay down the principal mortgage on your principal residence, that same amount gets increased in the home equity line of credit. Absolutely amazing, blew my mind. And the way it works is, let's just say you have $70,000 cash, okay? And we'll just use my house for an example, and I'll go over that in a little bit. But let's say you have $70,000 cash, okay? You're gonna buy a rental property. Let's say a $350,000 one-bedroom condo that rents for $1,650 a month, $1,700 a month, okay? What most people do, or what's typically done, is you get that rental income and then you pay off the expenses for the rental property, the mortgage, the insurance, the property taxes, the blah, 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 right? And you pay down the mortgage on the rental property. And you're going to do that. It's just kind of structured differently, okay? So you have your rental property that you purchased, you get the rental income. You're going to take that rental income and you're going to pay down the mortgage on your principal residence, okay? Now you're still making the payments on your principal residence. So now you're making two payments. You have the rental income and the normal monthly payment that you're going to pay otherwise. Both go to the principal mortgage of your home, okay? So rental income goes to the principal mortgage. From there, that's going to increase the amount you can borrow on the HELOC, right? Then you're going to take the HELOC and you're going to pay down the rental expenses, okay? Now, I know people are already going to say, why the hell would you do this right now? Why would you take on more debt in the current economy that is quite possibly collapsing right before our eyes? The reason why is because A, you're not actually going to pay anything additional out of pocket. This costs you literally nothing. Now, first off, I'm not a mortgage broker and I'm not an accountant, right? I am just showing you the rough idea. If you're interested in doing this, I will connect you with the people who know a lot more about it than myself. But from what I understand, you don't pay anything out of pocket. The minimum amount that you have to pay out of the HELOC automatically comes out of your checking account, and then you can literally just send the amount that came out of your checking from the HELOC back into your checking account. And you just let the debt accrue and grow within the HELOC. And every month you pay down the principal mortgage and the HELOC line increases. Right now, in this example, and why you'd be doing this to begin with is, when I looked at the numbers in year 10, I would only owe about $380,000 worth of principal on my principal mortgage, right? Now, if you look at an amortization schedule, loan amount of $835,000, year 10, doing it the normal way, I would still owe $668,000. Well, why is that? It's because you're making that extra payment from the rental income towards the principal. And what that does is it jumps you ahead in the amortization schedule. So for example, in year 2, I would owe $807,000 at the end of year 2, right? But if I paid an additional 10 grand in year 2 into my balance, well, that would actually propel me into year 3. And you'll notice every year you go down the amortization schedule, your mortgage payment pays off more of the principal and you pay less interest. So when you jump ahead of the schedule, each payment you make goes towards the principal. So every year, as you're paying down the mortgage with the rental payments, the principal payments that you're already making increase. So it's a snowball that's paying off your debt way, way, way faster. And in fact, in my scenario, buying that $350,000 one bed with my $835,000 mortgage on the principal side, my mortgage would be completely paid off in year 15. Hey, listen, there's a lot going on in Canada right now, and I am noticing that mental health is becoming a big issue here. And that's why I decided to partner with Focus Forward. So Focus Forward is a local counseling company out here in Abbotsford. They will help you with anxiety, trauma, depression, and all sorts of things. And although they're located locally, they can help anybody in BC virtually. And listen, they're covered through most extended medical benefits. So if you're working a job where you have that, you may just get your entire fee covered through those benefits. So I'm gonna drop their information right here at the bottom of the screen. And if this is something that you feel you're struggling with, feel free to reach out. Let's get back to the video. Now, the caveat is I would owe about $500 something thousand on the HELOC. But here's the amazing thing about the HELOC, and I'm not an accountant, so talk to an accountant. However, when you use debt to buy income producing assets, the interest you pay on that debt is tax deductible. So when I ran the numbers, because of my tax bracket, I'd be paying, 40%. I would get a 40% back. I would get 40% back come tax time. So I would pay like $36,000 in interest every year holding this HELOC. But then after the tax deduction, I'm net really only paying like $1,900 a month for that debt. But here's the amazing thing. If you wanted to pay off your mortgage, in 15 years, now your entire debt, which isn't tax deductible on the principal mortgage, is now tax deductible. But also, you now have options. Because what you could do is you could remortgage into another 30-year AM with a way lower payment and then do it again and buy another property. Or you could take the rental property and just straight up sell that and pay back the HELOC and have no debt whatsoever. And I think this is an amazing strategy for a lot of people. And like I said, had I known about this 8 years ago, I would have 100% been doing this. Because if you have stable income and you can easily pay your expenses, well, this is a very easy way to just basically unlock a whole new method of making more money. Because keep in mind, as you're holding this property, like I'm not even talking about appreciation. I'm not talking about the fact that rental rates typically go up every year. They're not right now, but if you hold the property long enough, you best be sure that they will. But during the entire time, this whole 10 years, I'm also paying down the principal of the rental property. Right? So I have another, 100 grand in equity in that principal residence or in the rental property just from the mortgage being paid down. I'm not even talking about the rent going up or the fact that it's probably appreciated as well. So the types of investors out there today they're still there, but they've just changed. They've become more long-term investors. They're people that are doing it for freedom later on. They're not doing it to make a couple $100 grand in the next 2 or 3 years. They're doing it for freedom later on. They're doing it to supplement retirement. They're doing it to clear off the mortgage on their principal residence. And yeah, I think this is an amazing way to supercharge the freedom that you want to have in your life and just get rid of your mortgage. And I think it gives you a lot of options. And again, the way that I see it, this doesn't cost you. Yes, you have more risk on paper, but it doesn't actually cost you any more money right now. You're not paying another mortgage, right? You're just letting the debt accumulate on the HELOC side. But again, if you really want to find out about this, you want to know more about it, I will connect you with the people who can show you the ropes and actually show you how it works. So if you're interested in that, make sure you use the link in my description to book a call to chat with me. Otherwise, I just appreciate you guys for watching. I'm that Agent Kelly. I'm making moves to move you. Peace.